Welcome to the videos on intermediate options. So far, we have looked at the four basic option strategies: the long call, the long put, the short call, and the short put. In these videos, we are going to be combining two options together to create what's called a spread. This group of spreads that we're going to be looking at are called verticals. They contain the bull call, the bear call, the bull put, and the bear put. Verticals are going to be a go to strategy when trading, and we're going to be thoroughly discussing their benefits and uses. Now, these strategies are going to look very similar, and it's easy to get them confused with each other. So, when I was first learning these, I would draw them out in a notebook and refer to them. And I suggest you do the same until you can instantly recognize what spread you're looking at. So when we buy options, we have the opportunity for unlimited profits. But we can't allow ourselves to get too tempted by this idea. It's very easy to look at the risk graph and start counting up all of our profits. But remember, we can also lose money if the stock doesn't go in our favor. And if you're oversized in a position, your account can take a big hit. So, let's say Google is trading at 150 and we buy a call option. Is it really realistic to expect the stock to shoot to 200 in the next month or two? It's not likely to happen. So, what we're going to do with spreads is optimize our single option position. We are going to give up some upside profits, profits that may not have been realistic in the first place, and in return, we get to reduce our downside losses and provide an element of risk control to our position. So let's hop inside Thinkorswim and take a look at the first vertical spread, the bull call. Okay, so I have the option chain for Tesla set up, and we're going to start by buying a call. I'm going to go into the Jan monthlies and I'm going to select the 450 call option. Take a look at the risk profile, and we can see that we have some nice, healthy profits if Tesla continues to move up. But we have a bit of a problem in that this option contract is expensive. It's $2,580. And if we've got a smaller account, say $10,000, that's 26% of your capital right there in one trade. So we don't want to do that. It's not good account management. So let's see how we can control our risk a little bit better by turning this into a bull call spread. And we're going to do that by selling a call in the same expiration series, but further out. So I'm going to look at the 470 strike and we're going to sell a call. So we are buying the 450 call and selling the 470 call. Now, let's take a look at our risk profile and see what it looks like. You can see that at the 470 short call strike price, we have capped our maximum profit potential. This is the new maximum that we can make. And in exchange for doing this, look at our loss. We've reduced it substantially. So, where is this 625 number coming from? Well, it is the debit we paid for the long call minus the credit we received for the short call. So 2580 minus 1955, and that gives us a total cost of 625. So on the other side, our maximum profit is about 1400, and we get this number by taking the width of the spread, which is $20. We multiply that by 100 shares. So we get a maximum potential profit of 2000. But we have to subtract the cost of the spread, which is 625. So we get a maximum potential profit of 1375. So essentially, the vertical spread is a compromise. We are giving up potential profit past the short strike, and in return, we get to decrease our trade cost. We can also reduce the width of our spread so we can make the trade more or less expensive. So if we reduce the width to $10, you can see that we have reduced the cost of this trade even further, but we have also reduced our potential profits as well. So you can choose how aggressive you want to be with your positions. If we're in a strong uptrending market, you can go wider. And if the market is looking iffy or you're not as sure of your trade, you can reduce the width and go shorter. It's up to you. So I'm going to change this back to 470. Um, this is still a bullish trade because the long call has the biggest delta. Therefore, it is the dominant option. The gains from the long call overpower the loss from the short call. So, if we look at the Greeks here, we can see that the long call has a delta of 44.32, and the delta of the short call is negative 36.49. And if you put them together, we still have a positive delta of 7.84. It's a much smaller delta. We've muted the intensity of this position or because we have a smaller delta, the gains and losses will accumulate more slowly. Another characteristic I want to point out is theta. If we look at theta, we can see that we have a negative number, which means that we are losing money every day on this position. But look at the purple line. Remember that the purple line collapses down into the blue line at the date of expiration. So let's go ahead and say that Tesla moves up to 485. Now we can see that we have a positive theta number, which means we are now making money every day due to time decay. This is because the positive theta on the short call is larger than the negative theta of the long call. So I just want to point that out that as the stock price moves upward past a certain point, you are going to begin making money every day from time decay. So that is the bull call spread. Now let's take a look at the bear call spread.